In this example, we will look at the IFRS 7 disclosures. Scenario 1. The following details were included in ASEAN Limited's trial balance for the year ended 30 September 2012. Opening balance for ordinary share capital, retained earnings, profit for the year, other comprehensive income, issue of preference shares, issue of convertible debentures, pre-tax amount of 196,046, as well as a post-tax amount. Disclose the statement of changes in equity for the year ended 30 September 2012 for ASEAN Limited. The total column and comparative figures are not required. How to approach such a question? First step, include your template. Now your template will include your ordinary share capital column, preference share capital, retained earnings, and then guys, important, you should be led by the information that they provide to you. They've indicated to us that there is other comprehensive income. Now guys, an assumption, this is your mark-to-market reserve. However, they should have told you this, or you should have calculated this. Okay, now guys, they either should have told you that this is mark-to-market reserve, or you should have calculated this. And then they provide you with convertible debentures. A post-tax amount should be used. And you need to add these two columns in your template. Balance at the beginning of the year, they've provided us with our 3 million ordinary shares and our retained earnings. They've provided us with a profit for the year amount, the 3535648. They've indicated to us our mark-to-market reserve, 331352, and the 1.4 million issue of preference shares. And important, our convertible debentures should be an amount after tax. Scenario 2, investment in listed bonds. You will identify on the left-hand side our question information, and on the right-hand side our requirement as well as the solution. Now, why do I include everything on one page or on one screen? I want you to be able to link the solution to the information provided in the question. Let's read through the information. On 1 July 2013, Exclusive Bikes Limited invested in listed bonds in Dollar Dream Limited. Guys, if you look at this, in the records of Exclusive Bikes, we will recognize a financial asset, and in the records of Dollar Dream Limited, a financial liability. On this date, Exclusive Bikes Limited estimated the 12-month expected credit losses on the bonds at an amount of 35,000 Rand. The bonds were purchased on the following terms. Now you can read through the terms on your own. The coupon interest payments have been received by Exclusive Bikes Limited on time on 30 June 2014. On 30 June 2014, Exclusive Bikes Limited assessed the credit risk of the bonds in order to estimate the expected credit losses at reporting date. During this assessment, the directors of Exclusive Bikes Limited obtained information that Dollar Dreams Limited was in financial distress. Now, immediately the question, is there a possible credit impairment on this investment? Exclusive Bikes Limited determines that the credit risk of the bonds increased significantly since recognition of the bonds, and that the bonds are now credit impaired on 30 June 2014. Consequently, Exclusive Bikes Limited measures the lifetime expected credit losses on 30 June 2014 at 125,000. Remember guys, when you look at the theory that we have to study, our expected credit loss model, I've included this at the bottom right corner. Remember, if an asset is credit impaired, we will have to recognize our lifetime expected credit losses. Now with this asset, there is a movement from recognition of 12-month expected credit losses to a significant increase, and this will now be recognized based on our lifetime expected credit losses. On 1 July 2014, Dollar Dreams Limited renegotiated the terms of the bond with the directors of Exclusive Bikes Limited, and the future cash flows of the bond were amended effectively from 1 July. In the next paragraph, the modification of the cash flows of the bond contract does not result in a derecognition of the bond. Therefore, this will not result in a derecognition of the financial asset in Exclusive Bikes Limited's records. On 30 June 2015, Exclusive Bikes Limited determines that the credit risk of the bond has still increased significantly since initial recognition and measures the lifetime expected credit losses on this date at an amount of 165,000. The bonds remained credit impaired on the date. The market-related rate applicable to the bonds was 6.8% per annum on the date the bonds were purchased and 7% per annum on 1 July 2014. Exclusive Bikes Limited correctly classified the investment in bonds as a financial asset at amortized costs in terms of IFRS 9. Okay, now guys, you can read the additional information. I want to read through the requirement with you. With reference to the investment in listed bonds, disclose, therefore you need to know that this is in a note. Remember, if they've indicated to you to present, this will be on the face of your statement of financial position. The changes in the loss allowance of the bonds in the financial statements of Exclusive Bikes Limited for the year ended 30 June 2015 in terms of IFRS 7, paragraph 35H, and the illustrated example contained in IFRS 7 IG 20B. Comparative information is required. Now guys, do you know what you have to do? No, but you have your textbook with you. They indicate to you the paragraph that you can open for guidance as well as the example. Therefore, please open your IFRS 7, paragraph 35H. IFRS 7, paragraph 35H. Remember, you are not allowed to write in your standard. I will write to explain to you. Now let's read through the paragraph. To explain the changes in the loss allowance and the reasons for those changes, an entity shall provide by class of financial instrument, this is important guys, by class. Therefore, in our example, this is a financial asset at amortized cost. A reconciliation. Now, what is a reconciliation? There will have to be an opening balance and a closing balance and a movement. From opening balance to closing balance of the loss allowance in a table, important, showing separately the changes during the period for 1. Our 12-month expected credit losses, 2. Lifetime expected credit losses, and our lifetime expected credit loss can either be when the credit risk has increased significantly but is not credit impaired, or where the asset is now credit impaired, or when there's trade receivables, contract assets, or lease receivables for which the loss allowances are measured in accordance with the following paragraph. Then C, financial assets that are purchased or originated credit impaired. Now, when you refer back to our information in our question, we need to disclose. Therefore, guys, first step, include your table. Step number 1, include a table. Remember comparative information. Step number 2, ensure that you have all of the line items and columns in your table. Now, when I refer to line items, this will be your opening balance on 1 July 20.13, your closing balance on 30 June 20.14, and your loss allowance on 30 June 20.15. Now guys, when you look at our timeline that I have included, on 1 July 20.13, they've indicated to us that there is a 12-month credit loss allowance of 35,000. Therefore, in your table, new bonds originated 35,000. Then on 30 June 20.14, they've indicated to us that the credit bond will now be credit impaired. Therefore, this is a movement from our 12-month allowance to credit impaired. And we need to take this out from our 12-month expected credit loss column and transfer to our lifetime expected credit loss column. And now important, guys, there's changes in our risk parameters of 90,000. Remember that they've indicated to us the closing balance on 30 June 20.14 is 125,000. Therefore, there will be a movement of 90,000 that we will have to recognize. Then the credit impaired, our lifetime expected credit losses for 30 June 20.15 will be 165,000, and therefore for our year end 20.15, a movement of an additional 40,000 due to changes in risk parameters should be recognized. Now guys, important, you need to spend some time with IFRS 7 to ensure that you know where the paragraphs are situated. When the requirement indicates that you need to disclose that you are able to open your IFRS 7 immediately and view the applicable paragraphs.